There are 3 sections of the Internal Revenue Code that allow money inside of a life insurance policy. I'm talking about a cash value permanent life insurance policy to accumulate tax-free. You can access that money tax-free. And at the end of the day, when you die, it blossoms, it increases in value and transfers income tax-free. So in this educational episode, I'm going to address the question, are life insurance policies, in particular, permanent life insurance policies, tax-free? Yes, they are, and I'll tell you why. So I'm Doug Andrew, and I've been helping thousands of people now for nearly 5 decades optimize their assets, minimize taxes, and get ready for long-term goals such as a comfortable retirement where they will not outlive their money. If you've watched very many of my educational episodes on this channel, my favorite financial vehicle is, bar none, a maximum funded, properly structured, indexed universal life insurance policy. Why? Because if you take out an IUL policy from an agent who does not know what they're doing, you might be lucky to gross 7% rates of return over the life of that plan and net 4 or 5% because they don't know what they're doing when they're structuring it. Most of my clients want to utilize universal life for living benefits because it will knock the socks off of traditional accounts like IRAs and 401ks because they're totally tax-free, whereas IRAs and 401ks are only tax-deferred. But I also earn higher rates of return. On a property structured IUL, I can diversify it and reallocate, rebalance it every single year. And by doing that, I have actually averaged for myself and clients 11.17% ever since 1997 when Indexed Universal Life was first introduced. If you go clear back and incorporate Universal Life, starting in 1980, my average return has been 9.62%. So if you round that down to 9.6, divide it into the rule of 72, your money doubles about every, 7.5 years. If you're earning 11, netting 10, 10 into 72 means your money doubles every 7.2 years. So I love it because my money grows tax-free, doubling about every 7 to 8 years. I can start out with 125 grand and it doubles to 250, 500 to $1 million to $2 million in 30 years. And so it's really one of my favorite financial vehicles. And so people then say, well, are they taxable? And I go, no. And of course, the next question is, well, why? As soon as the IRS finds this out, they're going to close this loophole. And I just snicker and I go, no. The IRS is very well aware that these are tax-free. It's not a loophole. In fact, the IRS dictates under Tax Citations, if that's your goal is to accumulate money totally tax-free for living benefits instead of just a death benefit, they actually dictate how you comply so that it will be tax-free. It's no secret, okay? It's no loophole. And so this has been sort of a tax-free cash cow in the Internal Revenue Code since, 108 years ago. But see, before 1980, there was only whole life that had cash value. Otherwise, you bought term insurance. Whole life, it was okay, but whole life was designed to primarily achieve the goal of guaranteeing a death benefit, which is going to be income tax-free under Section 101A of the Code. Whole life was never designed on a chassis to optimize internal rates of return for retirement income to be tax-free, for the living benefit. You can use whole life for some living benefits, but if you ever ask a whole life agent, illustrate the maximum income I can take out of this whole life policy, even if I pay the most premium the IRS allows, illustrate the maximum income I can take out so it won't lapse until I'm 120 years old. Then you compare that to what an IUL policy can do, and the whole life won't even come close. Basically, some of the best whole life policies I've ever seen illustrated were assuming an 8% dividend rate. And it took until age 95 before the cash value internal rate of return retroactive back to day one was 5.9. In other words, if you were to earn 8, you're only netting just under 6. With IUL, I can earn 11 and net 10. So it's a no-brainer to me. Now, they're tax-free. Why? Okay. The money inside of a life insurance policy has always been sort of a sacred tax-free cash cow because you're taking pressure off of the government to take care of widows and orphans if you happen to die early. If I have, as I'm raising my little toddlers, and if I was making $100,000 a year, the insurance companies can't just let you take out $1 bazillion of life insurance. There must be an insurance capacity. Usually when you're young and you have dependents, you can insure yourself maybe up to 30 times your income. So if you're making $100,000, they might approve you for a $3 million policy. But they're not going to approve you for 10 or 15 million because there's too many kooks out there that will take out a $30 million policy, pay the first month premium, and then tie some dynamite around them and blow themselves up for their cult, okay? There's too many kooks, so you can't just do that. You have to qualify physically, mentally, and you have to qualify by your earnings or your net worth. The older you get, the lower the rate is of your income or the multiple of the factor. When you're age 60 to 65, they may only insure you for 12 times your income or 7 times your income. So now they'll insure you for 1 or 2 times your net worth. So if your net worth is 5 million, they'll insure you for 5 million or maybe 10 million. Okay. So there must be a reason and justification for the amount of insurance you're applying for. And the beneficiary who's going to receive the money if you die, you have to prove that they're going to suffer an economic loss by virtue of your death. That's called an insurable interest. Well, when you accumulate money for living benefits, then you're taking the least amount of insurance the IRS will let you get away with. So you can put in far more money. So what happens is when I'm accumulating money and I'm putting in, let's say, $100,000 a year or $500,000, or to comply with TAMRA so that it will be tax-free when I start my income, you have to comply with TEFRA, DEFRA, and TAMRA tax citations. So let's say I'm 60 years old and I want to put in $500,000 in the next 5 years. Well, if I had $500,000 all in one fell swoop, I can't put it in there and have tax-free access because it only grows tax deferred. Now, if I happen to die, it'll transfer tax-free. But if my goal is tax-free income, I cannot put in all $500,000 at once. I can only put in maybe $100,000 to $125,000 a year, depending on my age. This is the TAMRA tax citation. Otherwise, it's going to be taxable if I start taking out income. I want tax-free. So let's say I put in $100,000 the first day of the first year, $100,000 the second day, the first day of the second year, the first day of the third year. Technically speaking, the fifth deposit I can make on the first day of the fifth year, which is 4 years and 1 day into it. So I put in $500,000, and now the $500,000 is my cash plus the interest on it. But let's keep it simple. Let's just say 500. That actually now is the cash value. And the insurance company is only charging me for the net amount at risk because the minimum death benefit was $1 million. So the cost of insurance now is for half as much insurance as it was 4 years and 1 day earlier. And so the cost of the insurance is getting cheaper. That $500,000 now will double, let's say in 7.5 years at a 9.6% average rate of return that I've achieved to $1 million. Now my cash value equals the original death benefit. The cost of insurance is Zippo, except the insurance company, under these tax citations that keep it tax-free, has to pay out 5% more than your cash value, but they're only charging you for $50,000 if you died when you have $1 million in there, because they pay out $1,050,000, but they're only charging you for $50,000 of net amount at risk because the $1 million is your own money now. Is that making some sense? So if you've never seen an insurance policy that gets cheaper as you get older, you haven't seen one done right. Why am I doing all this? Because my goal is to have the $500,000 double to $1 million. And if I'm not retired yet, I don't need the money, it can double to $2 million. It can double to $4 million. It can double to $8 million. We have many people that now have $8 million and it's generating $600,000 to $800,000 a year of tax-free income. Why is it tax-free? Because you took pressure off of the government and you complied. It's life insurance, but you're using it for living benefit. You're not going to have to rely on Social Security, welfare, charity, or your children for support. you're actually helping out the country. This is not a tax loophole. I can prove to you mathematically, you're helping out America more by using tax-free insurance contracts than is rolling over and accumulating $1 million or $2 million or $4 million in an IRA or 401k, and then you pull out your money and you're paying a third of it back to the government. You can do that, but you don't need to. You'll actually do more for America by not doing it that way. So other than that, I don't have any strong feelings on this subject, but in answer to the question, are life insurance policies taxable? Only if you do something dumb and you cancel it and you put in $500,000 and you got $1 million of cash value and you just cancel it before you die. That would be stupid because now you have to pay tax on the $500,000 of gain. You don't do that. You can actually borrow using your cash value, and you can borrow at 2%, and they'll keep crediting you 2%. It doesn't cost you anything to borrow, but you can borrow 94% of your money, and the remaining 6% will keep the life insurance in force until you die, and then it's tax-free. But see, that's far better to have 94% of your money tax-free. If you need all your money at once, which most people don't do, they just take out the interest on their money, not all their principal. But you pull out, on $1 million policy, you pull out $940,000 tax-free. If you pulled out the whole million, you would have to pay tax on $500,000 of that if your basis was $500,000 in the first place. That's dumb. You keep it tax-free by doing it the smart way. That's why it's imperative you understand how to do this, and you set yours up by using an agent that is proficient. Now, I want you to become proficient, and if you read this book, you'll know more than 99.9% of insurance agents that sell IUL. It's called The Laser Fund. It's my 11th book, and you can get a free copy. You can, of course, go to Amazon and pay $20 plus shipping and handling. If you do that, thank you. But you don't need to do that. I'll gift you a copy free. You simply claim your free copy by going to laserfund.com or click on the link below, and you contribute a nominal amount towards the shipping and handling. I require some skin in the game. Come on. But I'll cover the rest of that, and I'll pay for the book. I'll fire out a hard copy to you via priority mail. When you're in there claiming that free copy, check out audio and video formats if you like to listen and learn or watch and learn. We also have educational webinars you can register for. They're free. There's no charge. We do them on a weekly basis. You can even schedule an appointment to talk to an IUL specialist. I train a unique group. I've trained over 5,000 on how to do this right. And I have right now about 1,000 who belong to a coalition or network called IUL Insiders. And I train them on how to do it right. I strongly recommend you have it done right. Why? Okay, basically is because 99.9% of agents who sell IUL, if they sell you one, you're going to be lucky to gross 7% on that, and you'll only net 3 or 4% because they will not structure it correctly. I can show you how to earn 11 and net 10, which is a huge difference, and that's why a properly trained, proficient IUL Insider will show you how to do it the right way. So this is not about me. This is about your brighter future. Claim your free copy, and I'll see you on the other side of your brighter future.